Hey guys, it's JB here with an all-new episode of What Are Your Thoughts? Welcome back. Here with Michael Batnick as usual. Michael doesn't know what I'm going to ask him, and I don't know what he's going to ask me. Stick around, play around in the comments section below. We love having your feedback and your input in the show. We will get right into it after this quick break. Okay, Batnick, what's going on? Everything good?
What's happening?
What does the bottom of that shirt say? Legion of
Doom.
Oh, all right. Let me see. Like,
really?
Lift it up a little bit. Let me see. Not like lift your shirt.
WWF?
Oh, all right. I wasn't.
Was this after your time? How old are you?
No, I'm aware of it. My wrestling stuff, I probably lost interest in the late 80s. So it's definitely after my time. All right. I want to ask you about one of the craziest things that I saw this week. We are now at an all-time high for United States net worth, household net worth, which I just find, I don't know if it's vulgarity per se, but I'm not excited about it the way that I should be, because I just feel like there's so many caveats. But this is the Wall Street Journal. The net worth of American households and nonprofit organizations jumped 6.8% in the second quarter, from the first to $118.96 trillion, which is $380 billion more than what it was at the end of 2019. And that's before the coronavirus pandemic wiped out $7 trillion of household wealth. So not only have we gained back all of household wealth, we're now above where we were at the end of 19. It just seems unfair is the wrong word. Bittersweet?
You could say unfair.
But unfair to who, right? Like the people, nobody did anything wrong. Like I feel like it's fair that people's net worths have recovered. Maybe it's just it's sad the way it happened.
But the reason why we're at an all-time high is because the people that own all the stocks are at an all-time high. It's that simple. So the recovery has been incredibly uneven. People that have been displaced by COVID are still struggling to get out, and all the gains have gone to people with stocks. So it's pretty shitty.
Yeah, so you're exactly right. The component that moved the most this year because of the pandemic, not housing, stocks. Corporate equities owned by households fell 25% in Q1 from the end of 2019. Most of that happened in March, obviously.
Well, so all of the losses were felt by the top 1% on the way down, but they didn't feel it, obviously, because Jeff Bezos could lose $30 billion and he wouldn't notice. And then on the rebound, they got all of the upside, and the people who got hurt did not rebound. So
right.
Not great.
Now, one thing that's interesting is the personal savings rate, which has absolutely exploded. A lot of the households that received federal aid were able to save that money.
Some paid down debt.
Some paid down debt. A lot of people were able to push off spending on certain things like vacations or whatever. And as a result, the personal savings rate, so this is defined as the amount of households after tax income that they didn't spend, surged to a record 26% in Q2 from 9.6% of the first. 26% personal savings rate is insane. I was thinking, you look at a 10-year treasury right now at 70 basis points, which, by the way, the 10-year seems to have been stabilizing over the last couple of months around these levels. I probably shouldn't say that out loud. We'll see what happens next. But part of what's pushing that rate so low is demand for treasuries because of how much money is being saved by households and then how few commercial loans are being made by banks. So banks are doing mortgages, but that's pretty much it. So you don't have a lot of lending, which means banks have a lot of money on their balance sheets, and that's going into treasuries. And then you have this explosion in savings, which is also fueling demand for treasuries. And that's why you get yields pinned to where they are, despite the fact that the economy is recovering. And how does that change? What changes that?
Check this out. Ben just sent this to me. Look at this chart. The richest 1% of Americans own 31% of the nation's wealth.
Yeah.
And the richest 10% own nearly 69% of the wealth.
Yeah.
The richest 1% owns 34% of shareholder equity in mutual funds. Holy moly.
And we should point out that a lot of that is not people buying stocks, although some of that is. A lot of that is like people that work for giant corporations who have just been compensated in stock, and stocks.
It's inherited wealth. It's employees and it's founders, CEOs, founders.
And then stocks obviously outpace the economy by a huge degree and compound, and that happens over years and decades. And that's how you get to where you are.
Hold on, before we move on this real quick, the New Jersey governor floated a plan of giving every baby $1,000 or something like that worth of bonds. And I think that's a good start, but it should be the stock market. The country will never go for punishing the people at the top and redistributing the wealth like that. But I think that if we can maybe lift people at the bottom up by doing something like that, I think that's a solution that some people can get behind.
Yeah,
all right.
Bonds are a bad call.
Yeah, bonds.
Bonds that will underperform inflation. Great.
I think they were long-term bonds, so they're getting 120 basis points.
Useless. CPI is close to 2%. Let's say the Fed never gets above its target. I don't even know if there is a target anymore. At that rate, the buying power of the money put into those bonds will decline substantially by the time the baby can use it.
$1,000 today, by the time these kids turn 18, is 1,080. So real good.
That's good. Great idea.
Real good.
What do you got?
All right. I wanted to ask you about something that you were speaking about. So Rory Sutherland was on Patrick O'Shaughnessy's podcast. Did you listen to that?
I didn't hear it yet. I can't wait.
I have not read his book, which was a fan favorite last year or 2 years ago.
I have the book. And I have the book. I didn't read that either. I'm basically useless.
He said, if you want to get a rational bastard going around killing beautiful ideas, it's the easiest job in the world.
What is that? What does he mean by that?
Basically like, oh, this is never going to work. If this could have happened, it would have happened already. There's no moat. There's no appetite. It's stupid. Whatever. Yeah. And you were talking about something similar, not killing ideas, but like just being pessimistic all the time as an investment strategy. You were talking about that on your podcast last Friday, and I think that like for whatever reason, the burden of proof is always on the bulls, right? Like it's always like, oh, why is this going to work? Because it's so easy to come up with reasons why something is not going to work.
That's right.
Versus coming up with reasons why things are going to work. And I'm definitely guilty of this. I think we all are to some degree.
It's very hard to find a founder of a Fortune 500 business who's I don't want to say skeptical, because skeptical is actually a very good quality for business people and investors. Probably keeps you out of a lot of trouble. But like knee-jerk pessimistic. You're not going to find someone who's built anything or innovated anything whose default nature is to, look for all the holes in something versus look for the reasons. Look, I was reading the New York Times this morning. They did this huge story on electric car batteries. Today is battery day for Tesla. They're going to unveil something that probably allows a car to go 500 miles on a charge versus the current industry standard, which is 300. I don't know if that's accurate. We'll see what they say. That's the speculation. But they were saying in the article that all of the projections for how long it would take for electric vehicles to reach price parity with combustion engine vehicles, we are so far ahead of where the experts said. And they were saying if in 2010 you said that by 2025 it would be complete parity, people would laugh at you. But we're there. And in Europe, they're there already, and we're like 2 years out. And so you can drive a BMW 3 Series off the lot for $41,000, which is the same cost as a Tesla Model 3. And there are subsidies. The subsidies are going away, but they won't matter. The price of an EV battery has fallen by 80%. So now take your example, or now here's an example to what you were saying. Think about how many auto industry experts were just flat out saying there's no way this could ever work. Or it's 30 or 40 years away, or whatever the case may be, and we're there. And that was the harder call to say that we would get there sooner. And now, of course, all of the original equipment manufacturers in the auto space have gotten religion, but they're so far behind as a result of that pessimism.
What do you think the number is of people that have made money by being pessimistic versus people are saying with a default setting of that's never going to work? Is it 10 million to 1?
It depends on what their investment strategy is. I think I think there are people that just are not either optimistic or pessimistic, and they call themselves realists. And they tend to have hedges or diversified portfolios, and I don't think there's anything wrong with that. Not everyone has to be an optimist. I think it's not pessimism versus optimism. It's pessimism versus realism. That's maybe the real challenge, because when you've accumulated a couple of $1 million in savings and you have your retirement secured, you don't need to be a wild-eyed optimist and bet on, innovation as far as the eye can see. You can just be a realist and do okay. So I think that's the real battle.
That's what I concluded yesterday. I wrote about this. I said, nobody's all of one and none of the other.
Yeah.
Like, people could lean a certain way, but it's about balancing the competing ideas and living with the results.
One thing I've noticed about myself, though, is that my moods are extremely malleable depending on what the markets are doing. And I can definitely tell you about times when markets have been really rough and I've gotten more pessimistic, and then times when we're making new highs every week and I've gotten very optimistic. And I know that about myself, which is why when I discovered rules-based investing, it was a game changer for me, because it forced me to, I can still have those swings in my emotions and my pessimism versus optimism, but I don't necessarily act on it.
I'm basically the VIX. That's my emotions when it comes to investing. That's why I don't trade anymore.
Right. I want to ask you about 2% mortgages, which I think is where we're headed. All right. So this week, the average interest rate on a 30-year mortgage just hit an all-time record low, 2.86%, and that's average. So there are people borrowing for less.
15 years, 2.3, I think.
2.3. And there are people getting mortgages for less, depending on their credit rating, how much they're borrowing, what region of the country, who their lender is. I'm absolutely speechless. And so I guess what I wanted to ask you is, why wouldn't everyone just buy $1 million house?
Down payment. Next question.
All right, down payment of what? 10%. Anyone that's going to buy
you're not getting those interest rates with the down payment that low.
Anyone that's going to buy an $800,000 house, why wouldn't they just buy $1 million house?
You can obviously afford a bigger house with interest rates this low, but you still need to come up with a down payment.
And tax rates are low, interest rates are low. I feel like the amount of people who could just buy $1 million houses now, like
for sure.
The range of people who ordinarily would not be able to do that has just absolutely exploded.
Well, we see it in our town. You see some of these houses going for $800,000, and you're like, "Wait, what?"
Yeah, they're not $800,000 houses. I mean,
these are $650 in a normal market, I feel like.
Right. So we live on the water. We have $1 million houses everywhere, but then we have $400,000 houses, and the $400,000 houses are going for $600,000. And people are moving in knowing that they need $250,000 worth of work, and they're buying them anyway. So my jaw is on the floor, and I wonder how long rates can stay that low. I know it's a function of where the cost of money is from the Fed, but then I also think, like, we've got defaults, and mortgage forbearance will wear off, but that doesn't seem to really be affecting the rate at which people are lending. So I don't know what's going to change that.
According to Zillow, the median home price in our neighborhood is $566.
Right.
And once this gets updated for new homes, it's going to be, or existing home sales, it's going to go vertical. Yeah, it's pretty wild.
All right, what do you got?
A few months ago, we were talking about how, yes, a retail frenzy does eventually mark a top, but what really happens is that it's the supply that responds to the demand that soaks the market.
Yep.
Right? And that's really what ends it. So, Paul Ryan's got a SPAC.
Sure, why not?
Playboy is thinking of coming public in a SPAC.
Buy it up.
There was the Snow IPO last week. Sentiment Trader has this crazy chart. The number of first day doubles IPOs is rising. Not quite to what it was in 99, 2000, but it's getting there.
Yeah.
Are we getting there? Has Wall Street adequately responded? Or maybe it's not even Wall Street anymore. Maybe it's Silicon Valley. Is there more to come?
One of the counterbalances to the amount of, first of all, there has not been a ton of IPO supply, but yeah, Snowflake comes on the market. It's got a first day valuation of $70 billion. That money has to come from somewhere. Now, we just talked about the fact that the personal savings rate is more than 25% in this country. So there is money to continue to soak up supply of equity in different investment instruments. But you saw a lot of big technology stocks take a hit. I wouldn't be surprised if a lot of the money that ended up in Snowflake came from other tech stocks. Like, why would that surprise anyone? So we could see a continuation of that. But one of the counterbalances of there being supply coming to the market is that there's also supply being taken away. Don't forget,
Meaning?
a lot of companies slowed down their buybacks during the pandemic because there was this kind of batten down the hatches mentality in corporate America. We've never been through something like this before, and companies didn't know what the situation, like would they be forced to lay off half their workforce? Like, so the buybacks, I don't want to say they halted, but they materially slowed, and new announcements of buybacks went away. That stuff's all going to resume as the economy reopens and companies have a better understanding of what they can actually spend, what they could use to send capital back to shareholders. So don't be surprised if increased supply to the market in the form of SPACs and IPOs, et cetera, even secondary offerings, is offset by buybacks and literally stock being taken off the market.
What do you mean? You think Apple's gonna start buying back Snow's stock?
Not just Apple. Think about the S&P 100 and the cash generation happening there. And so if companies in the second quarter halted buyback activity or materially stopped buyback activity, and now we have a better idea of what the course of the virus might be. I'm not suggesting we do today, but we will. That's gonna be a change in mentality once again, because rates are still zero. It's very hard to put that money to work and earn a return on invested capital in any industry, even if you're in the highest growth industry imaginable. So that money has to go somewhere. It's not going to turn into dividends. So I think the buybacks return with a vengeance, if not in Q4, then certainly in Q1, provided the pandemic doesn't take a significantly worse leg higher. So, I think that's a counterbalance. The other thing is you still have this $1 trillion put out there in the form of private equity dry powder, and they will be removing more corporations from the market. They're not going to sit there. They're not going to send the money back. That's money that will be put to work. So what the money supply metrics are. I heard you and Ben talking about that on Animal Spirits. There is a ton of money in the system. It's going to be put to work, and most of it can't be put to work at 70 basis points in a 10-year treasury, on a risk-free basis. So, yeah, they're coming with supply. It will be a problem eventually for the high-flying growth segment of the stock market for sure. But you've also got these countervailing, I don't know if that's a word, forces that are taking the other side of that.
Next question. Good answer.
I was very bullish when I read about this, and I don't know if it's true. It's a Yahoo Harris poll that looked at the new generation of investors and investor diversity. And somebody writing about it for Bloomberg Opinion was saying that, quote, more than half the racial gap in individual stock ownership has disappeared essentially overnight. That's fucking awesome. Like, one of the silver linings of this pandemic is that young investors got involved. And because that younger generation looks more multi-ethnic, multiracial, multicultural, that's had a big impact on who owns stocks. And I know it's not really proportionate in dollar terms, but Black or African American, non-Hispanic investors went from 5% of those households owning stocks to 10, doubled from 2016. So in 4 years, we saw, I think the right way to phrase this is the amount of African American investors who owned individual stocks has doubled, and more than doubling for Hispanic or Latino households or investors. It's amazing. Did you ever think that we would see something like that happen so quickly?
What's the time? 2016 to 2020? Yeah, it's probably only going one direction.
But I mean, that is an epic change. I mean, it should be more, but
what do you think's responsible for this? I would just say probably technology.
I would say it's a stew of, first of all, the demography of that generation versus mine, or versus I'm a Gen Xer, or the demography of the boomers. I think there's better distribution of wealth. It's not great. We're not throwing a parade for it, but I think it's very obvious that we've made progress there. Technology is a huge leveler, and financial media, and even non-traditional financial media. I think
Barstool,
Reddit, Instagram, TikTok, people are reading about investing and seeing images of trading on these platforms. And it doesn't mean it's all good. It's just the point that like it's in the conversation among young people. It's really exciting. I mean, I would say that's like the best thing that's come out of this pandemic from an investment markets standpoint. Would you agree?
Well, I like all-time highs.
Right. So, yeah,
I'm kidding. Yeah, of course.
Too.
I mean, it's hard to come up with a list of good things that has happened in 2020. So I would chalk this up to one of them for sure.
All right. So now, what are the ramifications for financial media that they obviously want to talk to this new class of investor? The asset management industry does too, brokerage firms, et cetera. The ramifications of that is that, and I was talking about this in terms of our firm, firms and publications, they're going to have to look a lot more like what this demographic looks like, and figure out how to talk to them. I don't know if they have it figured out. What do you think?
I'm not sure. I think I see Robinhood advertising all the time. CNBC did a summer school trying to get involved with younger people. Cheddar is doing what they do.
Right. It's a drop in the bucket.
The problem is, and I hate to be a Debbie Downer, is that they don't have a lot of money
yet.
And well, I know, but I'm just saying, like the companies that spend a lot of money on advertising are not going to be too excited about like targeting that demographic. You're right. Yeah, I agree.
Yeah, because if let's say they market robo advisors to this group.
It's just a low margin. It's low margin.
They make barely any money on that. And this group is very hands-on. They might not always be. In fact, as they mature, focus more on their families and careers,
they definitely won't be.
The amount of trading will lessen, and they'll be less hands-on and more in need of help, which is why I'm so bullish about our industry. But right now, they're active. So I don't even know what you market to them. Commissions are free. Like, what are you even selling this demographic?
I do think it's great though. Yeah, that's right. I do think it's great though, because when I graduated college, nobody was talking about stocks or about trading stocks. They were talking about, holy shit, the world is ending. So I think the fact that so many young people are involved is a good thing. I totally agree.
And by the way, the world is still ending, but
it's true.
The world is literally on fire, and people are trading.
So, all right. I wanted to ask you, because I haven't asked you in a while, like, what are you doing?
With my hair?
That's a broad question.
No,
specifically. What are you doing at night? What are you watching?
Oh, well, sports are back, so
right.
I'm on the couch watching NBA playoffs, watching football. I don't really have any recs, or like I'm catching up on stuff like Schitt's Creek, which I watched the first season and then forgot about it, and then it was like up for all these Emmys. I'm like, what? Oops. I think I missed the boat. So I'm binging stuff like that. I don't know. I don't really have like any shows that are blowing me away. Oh, you watching that thing on HBO from Jordan Peele? No. What is it called? No. Lovecraft Country?
Love Country? Is it good?
Lovecraft Country. It's H.P. Lovecraft was a science fiction writer. So it's like no, it's the weirdest shit ever. I wanted to like it more than I actually like it. So, but I'm sticking with it. That's pretty much it. Why? What are you watching? What am I missing?
Yellowstone is excellent. It's kind of annoying.
What is that on? What network?
It's annoying because you have to pay for it. But whatever. It's $20 for the season. Stop.
I'm not. So I'll wait till it's on Netflix.
Kevin Costner is a patriarch of a family, and it's like Succession, Bloodline, and a little bit of Sons of Anarchy. It's high quality. Yeah,
I'm reading books instead. All right, let us know what your thoughts are and what you're watching. Give us some recs. I don't even know where to go or what to watch anymore. We love your feedback. Subscribe to the channel if you haven't already. I don't know what your story is if you haven't already. When you subscribe to the channel, you get the alert when this show is going to premiere each Tuesday at around 5:30. So you want to get that. Tell your friends about the channel too, and we will see you very soon.